Good morning. My name is Scott Redler, Chief Strategic Officer of T3Live.com, and you could say it this time.
And I'm Brittany Umar, and Happy New Year. We're back and setting you up for 2014 trade. We have mixed markets around the world this morning as 2013 closed with impressive action. We saw Europe and Japan close on highs and China trying to build some footing there. So before we look at our market, Scott, how do you think overseas markets are setting up for 2014?
Well, each one closed kind of differently. You know, you had Europe closing on its dead highs. You had the Nikkei close on its 6-year highs. And you had, China and the Shanghai trying to find its footing. So if you take a quick look at Europe, and I like to use Germany as a for instance, look at the move that this market had. And then look at the last few weeks. So a lot of people are pointing to the weakness in Europe today. So with that being said, I don't think you want to be too upset about it. Okay, I would say worry if some levels start getting breached. So I would say right here, this would be level 1 if you were looking to buy a dip, and then this is your real inflection point. This, I think, is the don't pass line for for Germany, and you could probably then overlay the rest of Europe. As far as just say the Nikkei, I'm not going to put that up. Actually, I'll put one of them up. That's not going to be open until January, or it's not going to be open until January 6th. And it's right at highs, and I do think this can continue. And then a little different, the FXI was a disappointment for 2013. I kind of think it'll be an accumulate for 2014. Overall, short term, this trend is still intact. I'd like to see it, work its way back. This will be big resistance, but I think if you short term want to trade it versus this 37 area, it did start to poke its head. We just have to worry about that credit crunch that people were saying, could get a little louder.
Well, in terms of our markets, our futures are off a bit. We did close on our highs on Tuesday. So what support levels will you be looking at to make adjustments for January's trade?
I was away the last week, and I was hanging out with my best friend who's a money manager, and he was taking phone calls all day long from clients who were upset that they had no losses to book versus their gains and had to pay taxes. And he was like talking to them. He goes, really? You're upset that you made money and have to pay taxes? And then they were talking about stocks, and it wasn't even about what the name of the stock was. It was whether it was up or whether it was down, and that's the type of dynamics we had going into the end of the year. So with that being said, today, tomorrow, the first 2 sessions or so, maybe people will just say, you know what, sell this now because I want to lock something in because they haven't locked anything in the past, few months. And because now they don't have to deal with it in April, they could deal with it, in 2015. So with that being said, we could then perhaps get a nice buy the dip because there's also new inflows that come to all the money managers. Some might be away this week as, it was a kind of week where you had New Year's midweek, and then you also have the snowstorm. But anyway, so if you look at the SPX, this is the levels that I'm going to be watching. First of all, look at this unbelievable move from November. I will not show this chart that many more times in the first few weeks of 2014. I'll start it from here, this most recent trend that did take place right around, what was that, October. So if you look at that trend, you will see that, you have a few levels here. This would be upper support. Like if we were to hold here, very impressive. That's around 1838, 1840. I even think if we get to the 8-day moving average, that would be impressive to hold. So if they want to keep things very pent up and very tight, we stay above 1813. I would say at some point in January, this will be the line in the sand. This prior breakout, that's where intermediate bulls would want to see hold, and hopefully that would be a good buying opportunity. So right now, you have support 1, support 2, support 3. I think, we're opening right around here. We'll see, how we close, but that's level 1 to trade against. And again, 8 days right here, so that's not too far away.
Well, let's take a look at some leading stocks and see how they look as we enter 2014. Let's start with high beta tech, where a lot of names had great 2013s, while others did not. But let's start with Apple, which is down about $4 to $5 this morning on a downgrade after filling most of the China mobile gap.
Yeah, it's getting a little bit random. And I would say today, for guys like me, it's going to have to hold a certain level. It was a great second half story. Lots of nice trends, some even breakouts in the name. It's been holding better since 2 quarters ago, but now it's at one of those spots where you have to really know your time frame. Okay, and recently, I didn't personally think it would fill the majority of that gap, but it did. So you had to base it on your own time frame. So you look at the chart here. We were talking about, first of all, this was the double bottom of the summer. Here's a trend that's still intact. All things are fine there. And then we were talking about time frame analysis. If it could hold 562. Chances were that it could have an end of the year move above 575, and it didn't. It filled the gap. So with that being said, if you sold here and got stopped out, you had a chance to get back in on Tuesday, but look how it closed on Tuesday saying, you know what, time to take this home. So you come in today, a little bit of a downgrade, which is, pain in the tush, but there was also an upgrade by Cantor. So we'll see what happens. Here's a 21-day. I would say really this is it. 552, right around there. If we get a close below 552, I know I will most likely be out of my Apple, and then I will figure out, can it hold this trend line? And this trend line comes in right around 540 with a small, point of reference right there. Let's hope that it goes from negative to positive today, and we don't have to do that, and then figure out at some point if new money flows come in and we do get a positive movement, within that first 5-day span that people talk about that's so important, then we'll deal with 571, 575. So here's your resistance, here's micro support, here's your intermediate support there in Apple.
How about Google? Had a really nice move since last quarter's earnings and is still riding the 8-day moving average.
This one's been, a much cleaner trade, a little bit easier, but obviously it's a high-price stock. It came out with some news today that they're lowering some handset pricing, so we'll see how it affects that. All in all, it's been riding the 8-day. You look at Google here, a lot to love on many different time frames. Here is that gap up after earnings, never got filled, led to multi spots to get involved for more cash flow, and then now it's right at one of those spots. It was weak on Monday, then reversed on Tuesday, closed near the high. So this one's hugging the 8-day, not the 21-day. So it's different. All things are built differently. So with that being said, short term, it's got to stay above this, just say 1107, and if it does, then maybe you get a momentum trade through 1121. That's your resistance, and then this is your more intermediate macro support that doesn't come in until about 1090.
Well, speaking of hugging the 8-day, so is Amazon. It's hugging the 8-day after trying to fall below it. Is this getting a little bit trickier here?
It is, because here you have the holidays are kind of done, so the whole story behind Amazon might be a little bit in the pasture, but it's still strong, and every time it looks like it's going to break, it doesn't. And you look here, so guys that traded, just say the Amazon little break here at 396, if you stayed a little bit too long, you were feeling it. You probably covered on Tuesday, and now it's probably opening down. So with that being said, here's your line in the sand, for the first few sessions here. I would say 391, 392. If it were to break below and close below that, more weakness can set in, and then you could see closer to 380. Little sideways action here, and if the money wants to come in and mark these leaders up again, or take them while they're hot and then distribute them later, then this is your support. So support 1, support 2, there's your resistance. I'm not going to be focusing too much on Amazon.
Well, you want to talk leaders in 2013, you got to talk 3D printing stocks, which also had a nice move to end the year well. 3D Systems itself what level does that need to hold right now to keep momentum intact?
I would say, it had a strong finish and had an unbelievable year. Investors that invested in this new technology. There you go. It's been actually around for 30 years, but really, got really focused on in the last year and a half. And this stock and this group, one of those things, if you had it in the drawer, multi-bagger, if you traded it, there were definitely price points to go after. And if you look here at the chart, you will see with Triple D, it's had a really nice move. This is, this was really the end of the year move. Once it poked its head above here, hopefully you got involved and, you rode it. So with that being said, short term, this 89.90 needs to be held, okay? You can even say this is a micro spot right here, which was Tuesday's low. So if we hold above here and it flags again, it could go. But this is one of those names that is up a lot on the year, and some people who didn't want to sell it and got lucky might say, you know what, let me book a little bit, and then we'll see what type of pressure happens. If the pressure doesn't come in and new money comes in, this is a candidate for new highs.
What about Stratasys, which also had nice action to end the year on highs?
Yeah, this one, it was funny because Triple D took off first, and everyone's like, what about Stratasys? I'm like, number 2 guy could probably go.
Right.
And you look here, it's had a nice move. This one had a really nice move. It broke above this little resistance. This was your day 1-ish, and then it came back to the highs, rested, and is there. So we'll see what happens today. Does it get engulfed and open down and close lower because of profit taking, or does it hold and continue that trend? And that's going to be the question on a lot of these. You look at some of the little ones in this group real quickly. You got something like an Onvo, which we were talking about last week. If you went after it, nice move, and we'll see. Maybe VJet actually wakes up a little bit. It's a new year, new flows, and it is getting tight. In order for this to make a move for a trade, it's got to get above 40 and finally hold it. Remember that was the piece when Muddy Waters said their earnings aren't quite there yet.
All right, well, coming up, we're going to go in the trenches with the banks and social media. But first, a quick commercial break. We'll be right back.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.
We're back and going in the trenches first with the banks, which we know had a big move on Fed Day, but hasn't seen too much action in the last few sessions. So are these on your watch list, Scott, for some better action?
Yeah, well, I would have liked to have seen new highs, but again, last week was very random, or earlier this week was very random. So first stock, Bank of America, is upgraded today. So it'll be very good to see if it could hold, this upper level and the pre-morning move, as the futures seem to be pretty negative. So with that being said, it's got to stay above, just say, this 1555. If it were to take out this 1575 to 1580 area and close above it in a weak market, that'll be your first sign of relative strength, and then perhaps that can continue. So for now, I do think it's on the radar today to show relative strength and get above 1570, but if it goes red today with the market, then chances are this range that's been being put in place here will need more time.
And Goldman closed well on the year as well. What level would you say it needs to hold?
This one, I took profits on, but again, it was like the slowest breakout move you've ever seen in Goldman. But with that said, there's not much earnings growth there anyway, so I guess you got to take what you can get. This was your last, nice breakout trade between 170, 172. It held the 8-day, closed green. See, today, if it goes from negative to positive and gives a push, you'll know that this is going to help provide leadership for the banks. If it comes back into the 8-day and doesn't hold it this time, then perhaps the banks will get some pressure. So I would say short-term watch 175. If it goes green today and trades above Tuesday's high, that could help the banks, and then you'll see north of 180.
How about Morgan Stanley? We saw it perk up on Tuesday. Do you think that move continues?
Morgan Stanley has pretty much, at different times, it said, okay, now I want to go, look at me, and it did have a day one on Tuesday. So with that being said, if the banks do get some strength and money goes there in the first week or two, you now have a day one in Morgan Stanley. So right here is your support. That's about 31. It did engulf these 5-6 days. So if the market doesn't want to come in today, or it wants to be very small to the downside, this should go green and trade above Tuesday's highs. And then at some point, the prior highs of the fall get taken out. So I would say day one puts us on the radar. I might even look at it this morning, as I'm not long there today.
Well, social media was also a great spot in 2013. We know Twitter had a really nice move from the low 40s, but pretty much seemed to throw in the towel at the end of 2013. So what are you watching here?
It did it very begrudgingly.
Right.
Everyone wanted it to throw in the towel early, and then finally it got hit a little bit, but it turned into this ultimate pain trade. So with Twitter, we talked about when it broke above 42 and broke above the IPO highs. That's healthy. You can look for gains. But when anything gains so much, people like to take the other side of the trade, and that turns into a pain trade. So my definition of a pain trade is this. If you try shorting a stock like Twitter too early, it's painful, you lose money. If you chase this stock during the last stage of that move and get long, usually that pullback is sharp and furious, and then you're in pain. So with that being said, you have to do it really right, and you have to be quick on your feet. So you look at the chart of Twitter, you will see that here's that 42-ish. Here's when it took out the IPO highs. Here was a really nice move. This is when, this is probably when the pain trade started. People thought this would be the top, and if they shorted here and didn't cover on this day, or when it took out that prior high, hopefully you were strategic and did it there, then this became another one. So with that being said, this was a little bit of a bull surprise, but you still could have shorted this stock when it opened around 70 and took out this low. Then you saw some support, a little bit of green. So I would say at this point, let's see what kind of Twitter we have. I personally think that this stock by 2015 could probably hit 100, but that's another conversation. But with that said, short term, here's your level to trade against. This is like 60-ish, and if it were to take out 65, perhaps it gets going pretty quickly. I would say if the bears want to stay in somewhat control, they don't want a close above the middle of this wide range bar. So with that being said, I continue to say take your trades with this one. If you're short, do it versus a level. If you're long, know your time frame or do it versus a level. But ultimately, stock still looks good. It's above the 21-day, and we should have some fun with this stock in 2014.
All right. How about Facebook? We know that it did have a nice move after the Red Dog reversal at the end of November, but since did pull back with the group, did hold the 21-day though. So does it just need some time?
I'd say, the whole group needs a little bit of time, but it's just a question of when does the speed of it come back. So with that said, it broke when Twitter broke, and rightly so. This was a really nice trade for a lot of guys in the community on this gap up. You had this gap up after earnings when they proved they can monetize, the handheld area, and then this is when it broke out. This was one top, and then finally here is when it broke. It did come into the 21-day and held. It's up a little bit this morning. I would say this is your lower area. If the bears really want to stay in control for a move, or a further retracement, they then should be protecting this, I would say, 56 zone. If it were to get above this prior pivot here, which is about 55.15, that's your route. That's the move. So at this point, you have support, the 21-day. This is a spot for a trade. If the market gets some strength today and it trades above this 2-day pivot, I would go with it. If the bears want to stay in control for downside to perhaps maybe even here, which I'll put the 50-day in another time, that's the levels to watch. At this point, I would click it. Just keep it light there. Very flexible in this social media spot.
All right. Well, what about LinkedIn then? Because we know it put another big year in the books, but it does look as though it's consolidating here. So what do you think about LinkedIn?
Well, it's kind of getting close to that, I would say, inflection point where a big move from 90 to 250,
right.
you would think consolidation is fine. So that just shows you need to know your time frame, and entries and exits matter. You look at the chart of LinkedIn, unbelievable move. This was that cup and handle pattern. This is when we put it in the Three Amigos. Here's when it broke above this 120, and since then, stair-stepped higher. So you had a bit of a corrective phase after the last quarter's earnings because it was priced to perfection, and it does have a high valuation. But now, as of now, coming into 2014, if you are trading this and you want to trade versus a level, it did hold the 200-day. This is some big support now going sideways. I would say 205 is your area. Okay, then at some point, if it wants to get going again, it'll break this area. So this is obstacle 1, obstacle 2. As of right now, you could be long versus this area, but if this area doesn't hold and weakness comes into the market, you could see a bit more downside considering where it came from. So just know your time frame. At this point, you could be a trader versus 205, 207.
All right, well, switching gears, a big part of Scott's theme for 2013 was going long the TBTs. Scott, does this remain a good spot to be in 2014?
Yeah, in the thesis we talked about putting this in the draw. I'm not sure if it was in the thesis or it was just we talked about it 100 times here. With that being said, I still think you could keep the TBTs in the draw for 2014. And the reason why we say that is because sometimes this is really hard to trade. There's a lot of professionals that are in this, that trade, the bonds and trade the 10-year yield and trade the TBTs or the TLTs. So sometimes it's easier just not to look at it. So with that being said, you look at the TBTs. At this point, this was when it crossed above that 70 and gave you a nice move to 82. You look where it is right now. After the Fed day, it went lower, and people are like, oh my goodness, what's going on here? And then you finally had this little red dog reversal, and then it tried to break out. So at this point, 10-year yield is hovering above 3%, building a bit of a floor. At some point, I do think this takes out 80, but it could be a little volatile. So keep it in the drawer. I would say don't overtrade it. If you are looking to trade it, a close above 80 could get you, a move back to this 82 pretty quickly. But I don't think this happens until later in the first quarter. And how about over in metals? We do have gold up this morning. For the gold bugs, does this trend change in 2014? Well, I think this was your January effect area. And that was one of the few areas that if you were long, which you had no reason really to be in 2013, that's where you could have just taken your losses. And you saw some maybe undue selling towards the end, and right now it's just having a reflex move up. So in order for this to be more than just a dead cat bounce or a January effect little trade, there are some levels that that it's going to want to take out and really ignite through. This has to wake up in order to get back on track, which I don't think it will, but who am I? We'll look at these levels. There are some gold bulls saying that it's gonna this is a double bottom off of that 114-ish. Okay, it closed decent into the end of the year. So I would say it's gapping up today. Let it gap up and hold, not gap up and be sold. If it gets gapped up and sold, you're going to see this level get taken out very quick. If it gap ups and hold, you could trade versus that gap, and then perhaps it could make its way to retrace up to 122, and then which would be surprising, this trend line of 124. if you look where it came from, it's got some room. Remember when it broke this symmetrical triangle there? Remember when it broke its macro 150 zone? So it's all the way down here. So if it wants to retrace a little bit, it could try, but if it doesn't retrace and get above this, you could see a lot lower prices for gold.
So then, in conclusion, wrapping things up, then what advice would you give traders who might find the first few sessions of the new year a little bit tricky?
I would just say do a little less, because it's going to be a little wishy-washy. You still have a lot of big players that probably took the week off, so they don't come back till Monday. We have this big storm in the Northeast that some people might not be able to get to work today or tomorrow or leave early, so volumes could be light. Then you have that phenomenon where the indices were really pushed in the last week to close the S&P almost near 30% and the NASDAQ even more than that, where you could just get some selling off in the first few sessions to book some gains, and then we'll have to see where support comes in, where does the new flows come in, and that could happen at any time. So with that being said, know your time frame, which we always say. Hopefully you're starting at zero and you could put your past behind you if you weren't happy with the way you traded in 2013. The market does not remember what you did, only you do. So if you do, hopefully you've already isolated your weaknesses, you start to work on them. And if you have some strengths that you made money with, you build on it. But no means try and get out of the gates and start running real fast. Take it slow. Let's figure out where the money goes, figure out what kind of composure we're going to have, figure out the speed. And then once things get a little bit more clear, we could figure out, taking a little bit more size and trying to take a little bit more out of some of those trades.
All right. And with that said, Happy New Year and happy trading. Have a great day.